Enron did not collapse because it lacked revenue. It collapsed because it redefined revenue. The company pioneered energy trading. It innovated in derivatives. It embraced mark-to-market accounting. Future profits were booked immediately. Losses were moved off the balance sheet. Special-purpose entities absorbed debt. Earnings appeared stable. Stock price rose. Executives were rewarded. But complexity is not transparency. When counterparties questioned valuations, the structure unraveled. In December 2001, Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. The failure was not one bad quarter. It was an incentive system engineered to obscure risk.
Enron was formed in 1985 through the merger of Houston Natural Gas and InterNorth. The merger combined pipeline assets across multiple U.S. regions. Headquarters were established in Houston, positioning the firm at the center of U.S. energy infrastructure. At inception, the business model was conventional and asset-heavy. Revenue was generated primarily through regulated pipeline transport fees. Earnings were stable because pricing was structured through long-term contracts. Risk exposure was largely operational rather than financial. Pipeline utilization rates determined performance more than market speculation. Capital allocation focused on maintaining and expanding physical infrastructure. The company operated within a predictable regulatory framework. In the late 1980s and early 1990s, U.S. energy markets began to deregulate. Federal policy encouraged competition in natural gas distribution. Fixed price controls gradually gave way to market-based pricing. Energy producers were allowed to sell directly into competitive markets. Volatility increased as prices began responding to supply and demand fluctuations. This shift reduced the certainty embedded in legacy pipeline contracts. However, deregulation also created informational asymmetry. Few participants understood how to price forward energy risk. Enron leadership identified this gap as an opportunity. Rather than remain a transport intermediary, the company began facilitating trades. It matched buyers seeking price certainty with producers seeking stable revenue. The company positioned itself as a risk transfer platform. Trading desks were expanded within Houston headquarters. Former bankers and financial engineers were recruited. Energy contracts were structured similarly to financial derivatives. Natural gas futures and forward agreements became central products. The company began offering long-term energy price guarantees. Clients increasingly relied on Enron to hedge exposure. This model shifted revenue generation away from physical throughput. Transaction volume became more important than pipeline capacity. Reported revenue expanded as gross transaction value was recorded. The firm described itself as a market maker rather than an operator. Electricity trading was added after state-level deregulation initiatives. California's power market became a significant arena. Enron entered power generation and trading simultaneously. The company began to construct an identity as an innovation leader. Bandwidth trading was introduced during the late 1990s telecom expansion. Weather derivatives were marketed to corporations exposed to climate variability. Each new product extended the trading model further from physical energy. The firm increasingly relied on financial structuring expertise. Revenue growth accelerated rapidly during the late 1990s. However, cash flow growth did not mirror reported revenue expansion. Gross transaction value became a headline metric. Margin transparency declined as contracts grew more complex. Internal systems prioritized deal flow over asset stability. The cultural center of gravity shifted from engineers to traders. Compensation increasingly favored transaction origination. The pipeline business became secondary in strategic importance. Risk migrated from infrastructure reliability to valuation assumptions. The transformation was structural rather than incremental. Enron had repositioned itself from a regulated utility to a financial intermediary embedded in volatile markets. Structural takeaway. Transforming from asset operator to financial market intermediary fundamentally redefined Enron's exposure to valuation risk and volatility.
Energy deregulation did not create Enron's ambition, it created structural space for expansion. Throughout the 1990s, federal policy reduced direct control over wholesale energy pricing. Natural gas markets became increasingly competitive. Electricity markets followed in selected states. Regulated utilities were required to separate generation from distribution. Independent power producers entered the market. Transmission access rules were standardized. Energy became tradable across wider geographic regions. Price volatility increased as supply imbalances became visible. Weather patterns began influencing quarterly earnings. Regional shortages created temporary price spikes. Market fragmentation generated arbitrage opportunities. Few legacy utilities possessed trading expertise. Enron positioned itself as a sophisticated intermediary. It built trading platforms capable of pricing forward contracts. Counterparties relied on Enron for liquidity. The company marketed risk management rather than commodity supply. Clients were told volatility could be converted into predictable cost. Enron structured long-term contracts with embedded derivatives. These contracts allowed gains to be recognized at signing. Projected cash flows were discounted into present value revenue. Reported earnings expanded without equivalent immediate cash inflow. Deregulation rewarded complexity. Complexity rewarded those who controlled valuation models. Enron invested heavily in quantitative pricing systems. Internal valuation assumptions became central to profitability. External oversight of these assumptions was limited. Energy markets were still maturing. Disclosure standards had not evolved at the same pace. Analysts evaluated growth using revenue acceleration. Gross trading volume became a primary narrative metric. The company expanded internationally. Emerging markets were targeted for power infrastructure projects. Political risk was priced into contracts. Long-term energy concessions were secured abroad. Projected lifetime contract values were recognized early. Accounting treatment amplified apparent scale. Regulatory bodies focused on market access, not balance sheet structure. Off-balance sheet structures began appearing in parallel. Deregulation indirectly reduced structural transparency. Competition intensified the need to report consistent growth. Management framed Enron as a model for the new economy. Energy was described as an information business. Technology language replaced utility language in investor presentations. Houston headquarters expanded trading operations. Headcount shifted toward finance professionals. The organization became dependent on transaction flow. Volatility became normalized within quarterly reporting. The external market rewarded revenue momentum. Internal risk aggregation became harder to interpret. By the late 1990s, deregulation had enabled structural leverage. Structural takeaway. Deregulation expanded opportunity, but it also amplified the importance of valuation discipline and balance sheet transparency.
Mark-to-market accounting became central to Enron's earnings model. The method allowed future projected profits to be recognized immediately. When a long-term contract was signed, estimated lifetime margin was calculated. That margin was discounted into present value. The present value was recorded as current revenue. Cash might not be received for years. However, accounting income appeared instantly. The approach was permitted under certain trading conditions. Energy contracts with measurable market inputs qualified. Enron expanded the interpretation of those inputs. Valuation models incorporated internal assumptions. Discount rates were selected internally. Forward price curves were estimated. Small assumption changes produced large earnings differences. Once revenue was recognized, subsequent quarters required validation. If actual performance deviated, adjustments were necessary. Adjustments threatened reported stability. To avoid volatility, new contracts were originated. New deals generated fresh mark-to-market gains. Reported earnings growth became dependent on deal volume. Internal pressure emphasized transaction flow. Long-term asset projects were also valued using mark-to-market. Power plants under construction were assigned projected profit streams. Those projections were recorded before operational completion. Broadband initiatives were treated similarly. Future usage assumptions drove reported profitability. Cash flow remained inconsistent. Operating cash lagged behind reported income. Analysts focused primarily on earnings per share. Quarterly guidance reinforced earnings expectations. Mark-to-market created front-loaded profitability. Later periods required either execution or replacement. If contracts underperformed, revised assumptions reduced equity. Balance sheet volatility increased beneath stable income statements. Complex valuation disclosures obscured methodology sensitivity. External auditors reviewed methodology but relied on management inputs. Arthur Andersen signed off on financial statements. Market participants assumed compliance signaled reliability. Credit rating agencies monitored leverage ratios. However, leverage measurement depended on reported asset values. Mark-to-market inflated asset bases. Equity appeared stronger than cash position suggested. The system rewarded optimistic projections. The more ambitious the forecast, the higher the immediate income. Future uncertainty was converted into present performance. The model required continuous confidence in valuation assumptions. Structural takeaway: mark-to-market accounting shifted earnings recognition forward, making reported stability dependent on sustained valuation credibility.
As mark-to-market expanded, balance sheet pressure increased. Recognized gains elevated asset values. However, associated obligations remained. Debt levels began rising in parallel. Maintaining credit ratings became essential. Investment-grade status reduced borrowing costs. Management sought structural flexibility. Special-purpose entities provided that mechanism. These entities were legally separate partnerships. They were designed to hold specific assets or liabilities. If structured correctly, their debt did not consolidate onto Enron's balance sheet. External equity participation was required. In practice, that equity was often minimal. The most notable vehicles included the LJM partnerships. They were managed by senior Enron executives. Assets were transferred from Enron to these entities. In return, Enron received cash or notes receivable. Loss-prone or volatile positions were moved off balance sheet. Reported leverage ratios improved. However, economic exposure frequently remained. Guarantees and side agreements connected the entities back to Enron. Valuations of transferred assets were internally determined. If asset values declined, the entities required support. Support often came in the form of additional equity guarantees. Complexity increased with each new structure. Financial statements disclosed their existence in footnotes. The disclosures were technical and lengthy. Few analysts modeled their contingent risk. Transactions between Enron and its entities generated additional gains. These gains were recognized through mark-to-market accounting. Earnings stability was reinforced. Risk dispersion appeared achieved. In reality, risk concentration persisted. The structures depended on rising Enron share price. Entity collateral often consisted of Enron stock. If share price declined, collateral value weakened. Trigger provisions required asset repurchases under certain thresholds. This created embedded liquidity risk. Credit rating agencies monitored disclosure. However, they relied on reported metrics. Off-balance sheet obligations were not fully capitalized. The appearance of balance sheet strength continued. Debt-to-equity ratios appeared manageable. Cash flow strain was partially obscured. The system functioned while equity confidence remained. As long as market value rose, structural fragility remained hidden. Special-purpose entities became shock absorbers for volatility. But shock absorbers transfer force, they do not eliminate it.
Structural takeaway. Off-balance sheet entities improved reported leverage while preserving underlying exposure, embedding hidden liquidity dependence on equity valuation.
As financial complexity expanded, internal culture adapted. Performance measurement centered on reported earnings growth. Quarterly targets became non-negotiable benchmarks. Managers were ranked against peers using performance scorecards. The company implemented a performance review system internally known as rank and yank. Employees were graded relative to one another. Lower-ranked staff were routinely exited. Advancement required visible deal generation. Transaction origination became the primary pathway to promotion. Long-term risk management carried less immediate reward. Mark-to-market accounting amplified short-term performance metrics. Large contracts produced immediate accounting gains. Deal volume translated directly into compensation potential. Bonuses were heavily equity-based. Stock options aligned pay with share price appreciation. Rising stock price validated reported growth. Internal messaging emphasized innovation and speed. Caution was perceived as lack of competitiveness. Risk officers operated within business units. Independence of oversight was limited. Internal debate often resolved in favor of revenue recognition. Complex transactions were encouraged. Financial engineering was treated as strategic advantage. Earnings smoothing became embedded in reporting cycles. If one division underperformed, another division accelerated deal closure. Late quarter transactions became common. Earnings predictability was maintained through structural maneuvering. Cash flow volatility received less executive attention. Balance sheet leverage discussions were secondary to earnings per share. External analysts reinforced focus on quarterly delivery. Missed guidance would threaten equity valuation. Internal compensation systems mirrored market expectations. Senior executives realized substantial stock-based wealth. Equity monetization programs were available. Stock sales occurred within compliance windows. Public confidence remained strong while price momentum continued. Internal dissent was limited by performance pressure. Organizational incentives increasingly favored appearance of growth. The system rewarded optimism embedded in valuation models. Structural stress accumulated beneath stable quarterly reports. By the late 1990s, culture and accounting were fully aligned. Reported performance became the organizing principle of decision-making. Structural takeaway. When compensation and promotion are tied to reported earnings acceleration, institutional incentives shift toward sustaining appearance rather than interrogating exposure. External reinforcement implicitly enhanced internal incentives. Equity analysts maintained strong buy ratings. Research reports emphasized revenue expansion. Complexity was framed as innovation. Conference calls highlighted growth in trading volume. Executives guided earnings expectations with precision. Quarterly delivery strengthened analyst confidence. Investment banks competed for underwriting mandates. Positive coverage supported equity issuance. Share price appreciation lowered cost of capital. Rising valuation increased collateral capacity. Special-purpose entities relied on equity support. As market capitalization expanded, structural leverage capacity expanded. Credit rating agencies maintained investment-grade status. Rating stability reassured counterparties. Energy trading requires trust in settlement capability. Counterparties assessed creditworthiness before contract execution. Enron's reported metrics appeared robust. Debt ratios reflected off-balance sheet exclusions. Cash flow volatility remained secondary in analysis. Institutional investors focused on earnings trajectory. Portfolio managers benchmarked exposure against peers. Selling a high-growth stock carried reputational risk.
Momentum reinforced participation. Internal communications highlighted analyst endorsements. Executive presentations referenced valuation multiples. Market capitalization became a strategic asset. Stock was used as acquisition currency. Equity swaps supported additional expansion. Perception enabled structural extension. Valuation credibility functioned as liquidity. As long as analysts maintained confidence, funding remained accessible. Risk disclosures were acknowledged but discounted. The narrative of innovation dominated financial coverage. Financial media celebrated the transformation of energy markets. Skeptical voices were limited in influence. Short sellers faced resistance from market optimism. Complexity deterred simplified critique. The structure required continuous affirmation. Perception and valuation became mutually reinforcing. Structural takeaway. Sustained external endorsement amplified internal leverage, allowing valuation credibility to substitute for liquidity discipline. Reported earnings continued to expand through 2000. Revenue growth exceeded that of traditional utilities. However, operating cash flow showed increasing inconsistency. Net income and cash generation began to diverge. Capital expenditures remained elevated. Asset sales were used to supplement liquidity. Special purpose entities recycled capital internally. Short-term borrowing increased. Commercial paper issuance became routine. Liquidity management required active refinancing. Counterparties relied on investment-grade status. Balance sheet strength was assumed. Equity valuation remained elevated. Internal risk reports noted exposure concentration. However, reported earnings overshadowed cash indicators. Market focus remained centered on growth metrics. In early 2001, leadership transition occurred. Jeffrey Skilling became Chief Executive Officer. Strategic direction did not materially change. Mark-to-market recognition continued. Off-balance sheet structures remained active. Share price began to experience volatility. Analyst questions increased gradually. Cash flow shortfalls became harder to offset. Asset monetization options narrowed. Counterparty confidence began to soften. Credit analysts requested additional disclosure. Liquidity forecasting became more conservative. Internal discussions referenced funding risk. However, public communication maintained stability messaging. Quarterly guidance was reaffirmed. Trading volumes remained high. Equity collateral remained central to structural support. Market capitalization began declining mid-2001. Collateral thresholds approached activation levels. Special purpose entities required additional support. Funding costs began to rise. Short-term liquidity buffers tightened. Structural fragility became visible internally before externally. Structural takeaway. When cash generation weakens while earnings remain strong, liquidity pressure exposes dependence on valuation-based financing. By mid-2001, equity decline began affecting structural assumptions. Market capitalization contracted materially. Collateral values supporting special purpose entities weakened. Trigger provisions embedded in agreements approached activation. Credit rating agencies intensified review. Analysts questioned transparency of off-balance sheet exposure. Liquidity forecasts were revised downward internally. Counterparties shortened contract maturities. Some trading partners demanded additional assurances. Commercial paper markets became less receptive. Refinancing required higher spreads. Cash management became daily operational focus. Internal projections showed narrowing liquidity buffers. Share price volatility amplified funding uncertainty. Mark-to-market adjustments reduced reported equity. Asset impairment discussions emerged. Certain broadband investments were written down. Investor confidence began to fragment. Executive communication emphasized stability. However, rating agencies signaled potential downgrade. A downgrade would activate debt covenants. Covenants required accelerated repayment under certain thresholds. Equity-linked guarantees increased vulnerability. Special purpose entities required incremental support. Enron issued additional public disclosures. Footnotes expanded in quarterly filings. Complexity hindered rapid external interpretation. Liquidity became perception-sensitive. Each negative headline increased counterparty caution. Credit lines were monitored closely. Internal treasury meetings increased frequency. Short-term obligations accumulated. Cash inflows lagged contractual commitments. Asset divestitures were explored urgently. Market participants began reassessing exposure. Trading volume remained active, but confidence thinned. Equity price decline triggered additional collateral requirements. Structural leverage reversed direction. Funding became conditional on confidence restoration. Confidence proved difficult to restore. Structural takeaway. Once equity valuation declines undermine collateral-based structures, liquidity becomes contingent and leverage reverses rapidly.
In October 2001, Enron announced a significant equity reduction. Previously reported earnings were revised. Certain transactions with special purpose entities were reevaluated. Shareholder equity declined by over $1 billion. The announcement triggered immediate market reaction. Share price fell sharply. Counterparties reassessed exposure limits. Credit rating agencies placed the company under review. Liquidity buffers narrowed further. Commercial paper access deteriorated. Short-term refinancing became constrained. Debt covenants approached violation thresholds. Equity-linked guarantees activated additional obligations. Special purpose entities demanded collateral support. Cash requirements accelerated. Asset sales were pursued rapidly. However, buyers demanded discounted pricing. Market perception shifted from growth to solvency. Executive leadership communicated restructuring intent. Merger discussions with Dynegy were initiated. The proposed transaction aimed to stabilize liquidity. Due diligence revealed deeper balance sheet complexity. Off-balance sheet exposure proved larger than modeled. Dynegy withdrew from the agreement. Confidence deteriorated rapidly. Trading counterparties reduced credit exposure. Energy trading volume began to contract. Cash outflows exceeded inflows. Employee equity value declined substantially. Retirement accounts concentrated in company stock fell. Funding sources withdrew incrementally. Rating agencies issued downgrades. Investment grade status was lost. Collateral calls intensified. Liquidity became critically constrained. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection. At filing, reported assets exceeded $60 billion. It was the largest corporate bankruptcy in United States history at that time. Structural takeaway. When confidence-based funding collapses, liquidity evaporates faster than reported assets can compensate.
The bankruptcy filing initiated formal asset evaluation. Creditors assembled to assess recovery prospects. Reported assets exceeded $60 billion at filing. However, asset liquidity varied significantly. Many positions were contract-based rather than tangible. Valuation depended on counterparty performance. Mark-to-market gains reversed under scrutiny. Certain previously recognized profits disappeared. Special purpose entities were consolidated during proceedings. Off-balance sheet exposure migrated onto the balance sheet. Debt levels increased materially after consolidation. Equity value was eliminated. Creditors prioritized secured claims. Unsecured creditors faced significant impairment. Energy trading operations were gradually unwound. Contracts were terminated or transferred. Counterparties sought settlement certainty. Arthur Andersen faced investigation regarding audit oversight. Confidence in accounting review processes declined.
Regulatory bodies initiated inquiries. Congressional hearings examined governance practices. Disclosure standards became central discussion topic. Executive compensation structures were reviewed publicly. Internal document retention practices were scrutinized. Institutional investors reassessed risk frameworks. Credit rating methodologies were evaluated. Market participants questioned structured finance complexity. Energy trading infrastructure was sold to competitors. Pipeline assets retained underlying operational value. Employees were displaced as restructuring progressed. Bankruptcy court supervised asset liquidation. Recovery rates differed across creditor classes. Litigation extended for years following filing. The collapse altered corporate governance expectations. Balance sheet transparency became regulatory priority. Structural takeaway: bankruptcy revealed the difference between reported valuation and realizable asset value under stress. Compensation had been heavily equity-linked. Short-term earnings recognition generated immediate personal gain. Long-term risk realization occurred later. Board oversight mechanisms proved limited in scope. Complexity reduced clarity of reported exposure. Audit independence was questioned. Financial engineering outpaced disclosure evolution. Credit rating reliance on reported metrics proved insufficient. Liquidity planning underestimated confidence sensitivity. Off-balance sheet treatment obscured leverage accumulation. Mark-to-market accounting amplified forward projection bias. Analyst consensus reduced skepticism. Market momentum reinforced participation. Internal dissent lacked structural support. Risk aggregation across entities remained fragmented. Stress scenarios were not fully capitalized. Collateral dependence on share price increased fragility. Once equity declined, leverage reversed rapidly. Covenant structures accelerated liquidity compression. Counterparty confidence deteriorated in sequence. Funding optionality disappeared. Reported earnings proved non-transferable to cash. Asset values required remeasurement under stress. Valuation credibility was the primary funding pillar. When credibility weakened, financing channels closed. The collapse was not a single decision failure. It was cumulative structural reinforcement. Each layer depended on prior confidence. Incentives favored continuity of growth signals. Transparency lagged innovation. Balance sheet interpretation required specialized modeling. External trust substituted for internal liquidity. Structural takeaway: incentive design, valuation methodology, and funding structure combined to convert volatility into systemic fragility. Enron collapse redefined corporate risk assessment. Regulators introduced new disclosure requirements. The Sarbanes-Oxley Act was enacted in 2002. Internal control reporting became mandatory. Executive certification of financial statements was required. Audit committee independence standards were strengthened. Off-balance sheet disclosures were expanded. Special purpose entity consolidation rules tightened. Revenue recognition guidance was clarified. Mark-to-market oversight increased. Credit rating methodologies evolved. Liquidity risk management received greater emphasis. Analysts incorporated cash flow metrics more prominently. Institutional investors diversified governance review processes. Board accountability expectations increased. Compensation committees reassessed equity concentration. Risk aggregation frameworks became more centralized. Stress testing gained institutional priority. Counterparty credit review standards tightened. Transparency became competitive advantage. Balance sheet interpretation became more conservative. Valuation assumptions required greater documentation. Short-term earnings growth lost some primacy. Capital structure resilience gained prominence.
Funding diversification became strategic objective. Corporate communication became more risk-sensitive. The event became a case study in finance education. Business schools revised governance curriculum. Regulators strengthened enforcement mechanisms. Corporate boards increased oversight capacity. However, structural risk did not disappear from markets. Financial innovation continued to evolve. Structural takeaway. When incentives reward appearance over substance, collapse becomes mathematical. Corporate collapse is structure meeting stress.